Today is Sunday, April 30. The market is closed, and we will be reviewing the Uber unusual option activity we saw on Friday, the last trading day, because earnings will be coming up on May 2nd, and that is actually before market opens. So tomorrow, May 1st, will be actually the last day to trade earnings for Uber. So let's get right to these unusual options. We saw three of them that were quite unusual, the three largest ones, and so we want to go over those. And here they are. 12:14 a.m. You'll see these May 5s, 27 strike puts, 20,000 of them, and then the 28 puts, 10,000 of them. You'll see that here. And then the second one we saw was 4,900 of them here. This here is the July's. This is at the 3:22 p.m. At the 22.5 strikes. And then the third one is this 3,000 contracts at the 32 strike calls for May 5, done at 3:55, just 5 days before the market closed. Okay, so let's go over this first one here. This was the 20,000 contracts and 10,000. So it looks like a back ratio. And so this back ratio strategy here, you'll see here, you've got this very large volume here. We know 20,000 of them were opened because it's a lot greater than the open interest. Same with the 28 strike here. 10,000 of them out of this 14,000 was done by this large institution because this is also greater than the open interest. Okay, so what we believe is happening here is that they had bought the 28 strike puts and sold two of these 27 strike puts. And so what happens with that is when you analyze this trade, you'll see that this is a 30, that the trade here at the current price of $31, if it goes down in price on the x-axis, it will try to hit this 27, which is where max profit is. And if it does land around that, yeah, that is very profitable for them. So 27 is that target price. And as long as it doesn't drop past this 26 around 25.9 is then going to be a profitable trade, because even if the price rallies, you'll see here they get to keep that credit that they collected for doing this trade. You'll see there is no loss. It's actually not a there is no loss on the upside for this back ratio strategy. One of the positive things about this trade is that it's a negative vega trade, which is very good for earnings, because we know that after earnings, volatility will decrease. So this is why this trade is very a good type of earnings trade, and why we think these large institutions are taking advantage of the volatility. And also this positive theta is also very good. Okay. And so you may also wonder, well, what if instead of doing this, what if they had bought two of those 27 strike puts and sold the 28? Let's say it's the other way around, right? What would happen then? Well, let's take a look. If they had bought two of these 27 strikes, if it was the other way around, and they sold the 28, what would that look like? You'll also see it is also bearish, right? It's a different structure. However, it's the same delta, the negative delta, where this will be profitable if the price drops from 31 down, right? And so either of the types of back ratios in this kind of a trade, it's still bearish. You'll see the Greeks, negative delta. This trade, as we said, the other one had a negative vega. This one has a positive vega and a negative theta. That's both of this is not as favorable for an earnings trade. That's why we think the other trade is more likely that it is the large institutions doing it. But in any case, both are bearish, and so we would say that this trade is biased towards the downside here. Okay. And now for the 3:22 p.m. trade at the 22.5 strikes. Let's take a look at that. That's July 21, 4,900 of them, right? And here we are. Let's take a look. July's. We'll see here it was at the 22.5 strikes. You'll see here volume very high compared to the open interest. So we know those are opening. Same with here on this side, also much greater than the open interest. So we believe on this trade, what they're doing here is they're buying the 22.5 strikes and selling the 22.5 strike calls. So that is a synthetic short position. And you'll see that also as the price goes down, this is increasing in profit because it's greater than the zero profit loss diagram. So this is a synthetic short. It is basically like owning 100 shares of the stock. You'll see the delta is very close to 100 here. And so we will, and you may also wonder, well, how do we know if it's buy or sell? Well, right here on the call side, we can see here that one of them is already being executed at the ask price here, right? So that is giving us one of the kind of clues as to how we know that this was the sell here and that this was the buy. Now, kind of same idea here, 355, this 32 strike also being executed on the sell side here, right? And so this one here, because we are slightly close to at the money here, we believe that this one is most likely a hedge. There was no other, you'll see that there is no spread here under the condition. This looks more like a covered call. This looks more like this large institution had shares of stock, and what they wanted to do was they went out here and they took the 32 strikes and they sold that strike. See the 40, there's much greater volume here. And here we are. They sold this because by selling one of these, what they did was they did they have stock in this. And so by doing that, they had stock, and what they're doing essentially is lowering their potential loss. So they're hedging their position. So their stock over at $30 is their break even now. So the stock after earnings, it could drop, but they won't be at a loss. And so by selling that call here, they are hedging the stocks that they have, right? And so that's what we believe is happening with this trade here, is that and if it does go up, it will be profitable, but it is limited. And so that is what a covered call is. So all three of these unusual options that we're seeing here is pointing to more of a bearish sentiment. And so what we're getting from this is bearishness. And so if tomorrow, the last day that we have to trade, if we start to see more bearishness on the unusual option activity, more of these different types of unusual options, then we will most likely put on a bearish trade for this earnings. And if we do see bullishness, we will definitely let everybody know. So make sure you are subscribed and you have that bell icon turned on for notifications, so you get notified right away if we see bullishness instead. Otherwise, we are planning to take a bearish position on Uber for the earnings, and we'll be able to put on a type of trade where we can reduce our losses in case it does rally, which it may, because anything can happen during earnings. And so make sure you're subscribed, and you'll find out what we do. And so hit that bell icon and smash that like button, and have a great day and good luck.